If you're scalping on the 5-minute chart and struggling to stay consistent, it's not because the strategy doesn't work, it's because you're entering at the wrong moment. This strategy will change the way you enter trades forever by helping you stop getting trapped while others keep losing money. It's built on 6 simple steps. We'll break them down one by one, and by the end of this video, you'll have a clear, structured, and highly effective trading system you can apply immediately. Here are the steps you will learn to master this strategy in this video. How to identify the right market context. How to spot a high probability flip level. How to identify the inducement behind the move. How to recognize the bait and switch that traps most traders. How to confirm the setup using volume. And finally, how to execute the trade with precision. I'll also walk you through a real chart example, so you can see exactly how to apply this strategy step by step in the market. But here's the important part. If you miss even one of these steps, you won't be able to use this strategy correctly because every part plays a key role. So make sure you watch this video until the end, because this strategy could completely change the way you trade. Before we get started, if you want more videos like this, make sure to like, subscribe to the channel, and hit the notification bell so you don't miss any new uploads. Let's start with the first step, identifying the right market context. Whenever you open a chart, you will usually find 4 main market conditions: an uptrend, a downtrend, and a range. Each market condition requires a different approach, and that is exactly what you will learn step by step in this video. Let's begin with the uptrend. An uptrend is simply a market that keeps making higher highs and higher lows. This tells you that buyers are in control, and the market is moving upward. Now pay close attention. When the market pushes up, creates a higher high, and then starts to retrace, the level where the retracement begins acts as a resistance level. If the market later comes back, breaks above that resistance, and then turns it into support, that level becomes very important. And this is exactly what we mean by a flip level. A flip level is when a previous resistance level becomes support. Once this happens, that area becomes a very hot point in the market, because it often attracts attention from both buyers and sellers. So, when the market returns to that level again, there is a strong probability that price may react from it and continue moving higher in the direction of the uptrend. So now you understand the first step, which is identifying the right market condition, and the second step, which is spotting the high probability flip level. Now let's move to the next step, identifying the bait and switch. The market comes back to the level, moves down, and breaks below it, giving traders the impression that the market is about to go lower. But instead of continuing down, price quickly reverses and closes back above the level. This is what we call a bait and switch. When this happens during an uptrend, it tells you something very important. The flip level is being defended, and smart money is active around this area. And this is where the opportunity begins. But we still need confirmation. This is where we use the volume indicator to understand what is really happening behind the move. If you look at the volume below, you'll notice that right after the bait and switch, there is a strong increase in buying volume, represented by a large green bar. This indicates strong buying pressure. It suggests that institutions are entering the market after the trap. Now we have a strong setup on the 5-minute chart. But before entering, we need to check the higher time frame. We can clearly see that the market is trending down. However, if we look to the left, we can identify an accumulation phase. When the market reaches this area again, it breaks below the support level and then closes back above it, forming a liquidity sweep. After that, price moves higher, which signals a potential bullish reversal. So, on the hourly time frame, we have a bullish reversal signal, and on the 5-minute time frame, we have a buy signal. This means the higher time frame is aligned with the lower time frame. Now, let's switch to the 5-minute time frame to execute the trade. Once everything is aligned, we execute the trade. Entry: at the close of the bait and switch candle. Stop loss: below the liquidity sweep. Target: the next key level. Always make sure your risk to reward ratio is at least 2 to 1. And as you can see, the market moves up exactly as expected. Let's quickly break down what you just did. You identified the trend. You spotted a key level. You waited for the bait and switch at that level. You used volume to confirm buying pressure. You checked the higher time frame for alignment. And then you executed the trade. This strategy is simple, structured, and effective. But like any strategy, it requires practice to truly master. Now let's look at another chart example. Here the market is trending down. We first see an impulsive move to the downside, followed by a retracement. The point where the impulsive move ends and the retracement begins acts as a support level. Now pay close attention. The market comes back and breaks below this support level, then retraces back to it. At this point, the level flips and becomes resistance. And this is what we call a flip level. When the market reaches this level again, it breaks above it briefly, and then closes back below. This is a bait and switch. It gives traders the impression that the market is going up, but then quickly reverses, trapping them. Now look at the volume below. You can clearly see a strong increase in selling volume, which indicates strong selling pressure. This suggests that institutions are entering the market after the trap. Now let's switch to the higher time frame. You can use the 30-minute or the 1-hour chart, but here we'll look at the hourly. As you can see, the market is clearly trending down, which aligns perfectly with our setup. Now let's go back to the 5-minute chart and execute the trade. Entry: at the close of the bait and switch candle. Stop loss: above the liquidity sweep. Target: the next key level. And as you can see, the market moves down and reaches the target as expected. You might think, this strategy is too simple. Anyone can use it, so it can't really work. Maybe you need something more complex to make money in the market. But that's not true. That's exactly where most traders go wrong. Let me share with you one of the most famous trading experiments ever conducted: the turtle trading experiment. In the 1980s, a legendary trader named Richard Dennis made a bold claim: anyone can be taught to trade. To prove it, he took a group of complete beginners, people with no trading experience, and trained them for just a few weeks. These people became known as the turtles. What made this experiment extraordinary is not just the results. It's the simplicity of the method. They were not using complex indicators. They were not trying to predict the market. Instead, they followed one core principle. They traded with the trend, with discipline. They entered when the market showed strength. They followed clear, rule-based systems. And most importantly, they executed without hesitation. The result: many of them went on to make millions. Now, yes, the markets have changed. But the core principle has not. The market still rewards traders who follow the trend, wait for the right moment, and execute with discipline. And this is exactly what you are doing with this strategy. You are not overcomplicating things. You are trading when the market is clearly trending, combining it with the bait and switch, using volume to confirm real participation. If you stay disciplined and follow this process, you will start to see consistent and impressive results over time. Now, you will not always find trending markets. In fact, trending markets occur only around 25% of the time. Most of the time, the market is actually ranging. A range-bound market is when price moves horizontally between support and resistance. This tells you that buyers are not in control. Sellers are not in control. The market is in equilibrium. When traders see this type of market, they try to force trades, trade in the middle of the range, and that's where they lose money. When you identify a ranging market, do nothing at first. Draw your support level, draw your resistance level, and wait patiently for price to reach one of these levels. Now, watch this carefully. As you can see in this example, the market breaks below the support level, and then quickly closes back above it. This is a clear bait and switch. This is your first signal. The second step is to check the volume. Look for signs of strong participation. If the volume shows a clear increase in buying pressure, this adds strength to your setup and confirms that the move is not weak. Finally, move to the higher time frame. Check whether the market structure aligns with your trade idea. This step helps you avoid taking trades that go against the broader market direction. Once all these elements are aligned, you have a high probability setup, even in a ranging market. Now let's look at this chart example. Here we are on the Australian dollar, New Zealand dollar, 5-minute chart. As you can see, the market comes up to this level and reverses, forming a clear resistance level. Then price moves down, hits this level again, and reverses, forming a clear support level. This is what we call a range-bound market. At this point, buyers are not in control. Sellers are not in control. The market is in equilibrium. Now look at what happens next. The market breaks above the resistance level and then quickly closes back below it. This is a clear bait and switch. It gives the impression that the market is going higher, but then reverses and traps buyers. This is what we call an institutional footprint. Now let's confirm this move using volume. As you can see, there is a strong increase in selling volume right after the bait and switch. This indicates strong selling pressure and confirms that sellers are entering the market after the trap. This gives more strength to our setup. Now let's move to the higher time frame. On the hourly chart, you can clearly see that the market was trending up. Then, it started to range and eventually reached this resistance level, where we can see a slight rejection. This indicates that the market is no longer likely to move higher and may reverse to the downside. This supports our trade setup on the 5-minute time frame. Now, let's go back to the 5-minute chart and execute the trade. Entry, at the close of the bait and switch candle. Stop loss, above the level. Target, the next key level. And as you can see, the market moves down and reaches the target as expected. This is how you apply the same logic in a ranging market, by waiting patiently for the trap at key levels, instead of forcing trades in the middle of the range. Now, let's look at another chart example. As you can see, the market was ranging, trading between a clear support and resistance. Then price breaks out of the range to the upside. This level was resistance. And after the breakout, it becomes support. This is what we call a flip level. Now, instead of chasing the breakout, you wait. You wait for price to pull back to the flip level. When price returns to this level, it breaks below it briefly and then closes back above. This is a bait and switch. It traps sellers and signals that the market is likely to continue higher. Now look at the volume. If you see a clear increase in buying volume after the bait and switch, it confirms that buyers are stepping in. This adds strength to your setup. Next, move to the higher time frame. As you can see on the hourly chart, the market is ranging. It has already hit this support level and is now moving toward the resistance level. This space between the current price and the resistance is what we are going to trade on the 5-minute time frame. So now, the higher time frame, which is the hourly, is aligned with the 5-minute time frame. Now go back to the 5-minute chart and execute the trade. Entry, at the close of the candle that closed above the level. Stop loss, below the same candle. Target, the next key level. And as you can see, the market moves up and reaches the target as expected. This is how you trade breakouts the right way, not by chasing the move, but by waiting for the market to come back, create a trap, and then confirm the real direction. Now, let's look at another real chart example so you can understand the steps exactly. Here we have the Australian dollar versus New Zealand dollar 5-minute chart. As you can see, the market forms a clear resistance level here and a clear support level here. This creates a range-bound market. Now look at what happens next. The market starts moving inside the range. And then suddenly, it breaks below the support level. This breakout is important, because once the support is broken, it becomes a new resistance. And this is what we call a flip level. So now we have market condition. The market is ranging. Key level. We have a support level that has turned into resistance. Now let's wait for the setup to form. As you can see, the market retraced back to the level, broke above it as if it wanted to close inside it, and then broke back below it again. This is a clear liquidity sweep at this support level that has turned into resistance. This is your signal. Now look at the volume indicator. You can clearly see a strong increase in selling pressure, which confirms that sellers are actively entering the market after the trap. This strengthens your setup. Now let's switch to the higher time frame. On the hourly time frame, which is the higher time frame, we can clearly see that the market has formed a support level and a resistance level. If you look at the market now, you can see that it is also ranging. It has reached this resistance level and is now moving down toward the support level, and this space is what we will trade on the 5-minute time frame. So now, the higher time frame is aligned with the 5-minute time frame. Now let's go back to the 5-minute chart and execute the trade. Entry: at the close of the bait and switch candle. Stop loss: above the level. Target: the next support level. And as you can see, the market moves down and reaches the target as expected. This is how you combine market structure, flip levels, traps, volume, and higher time frame confirmation to find high probability setups with precision. Now let's move to the third type of market you will often find. Take a look at this chart example. Ask yourself, is this a trending market or a range-bound market? The answer is neither. This is what we call a choppy market. A choppy market is when price moves without clear direction, creates inconsistent highs and lows, lacks structure. In this type of market, there is no clear control from buyers or sellers, and the market actually spends a significant amount of time in these conditions. This is where most traders lose money, because there is no clear trend, no clean levels, no reliable setups. Signals become unreliable. Patterns fail more often. When you open your chart and you cannot clearly identify a trend or a range, do nothing. Do not try to force a trade. If the market is not clear, stay out. Because the goal is not to trade all the time. The goal is to trade only when the conditions are in your favor. Sometimes the best trade is no trade. If you learn to avoid choppy markets, you will protect your capital and improve your consistency more than most traders. Now let me share with you some mistakes you could make so you can avoid them. Look at this chart example. As you can see, the market is clearly ranging, and then it breaks out of the range. At this moment, you identify a breakout, a flip level, and you tell yourself, I'll wait for the retracement, then I'll enter the trade. But look at what happens next. The market doesn't retrace. It continues moving up without giving you an entry. At this moment, most traders feel frustration, disappointment, regret. They think, I missed a big move, I should have entered at the breakout. And this is where the biggest mistake happens. Most traders then start chasing the market, enter too late, break their rules, and end up losing money. Your problem is not the strategy. Your problem is your mindset. Because what makes you profitable is not the strategy, the setup. It's your discipline. A professional trader understands this. Not every setup will give you an entry. Missing a trade is part of the game, and that's perfectly fine. If the market doesn't give you your setup, you don't trade. No emotions. No chasing. No regret. If you can accept missing trades and move on without emotion, you will avoid costly mistakes and stay consistent in the long run. The second mistake traders make is believing that this strategy works every single time. And this is a very dangerous mindset. Look at this chart example. As you can see, the market is in a clear uptrend. We have an impulsive move, followed by a retracement. Another impulsive move, followed by another retracement. This confirms strong bullish structure. Now, this resistance level gets broken and turns into support. So now we have a clear uptrend, a valid flip level. Then the market retraces back to the level. It breaks below support and closes back above. A clear bait and switch. Now look at the volume. There is strong buying pressure, which confirms participation. And let's assume the higher time frame is also aligned. Everything looks perfect. At this point, many traders feel, this trade is guaranteed. They enter the trade, set their target, but they don't place a stop loss. Because in their mind, I'm 100% right. But then, the market goes against them. The setup fails, and instead of closing the trade, they hold it. Waiting, hoping, praying. That price will come back. This is where psychology takes over. Confirmation bias. You believe the trade must work because all conditions were met. Sunk cost fallacy bias. You refuse to close the trade because you've already lost too much. And this is how traders blow their accounts. Consistency in trading doesn't come from being right every time. It comes from managing your risk and executing with discipline. If you found this video helpful, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next trading strategy. Thanks for watching, and I'll see you in the next video.